If you've ever gotten money back from your 401k plan because your 401k plan failed testing and you're a highly compensated employee, then this video is for you. So in a nutshell, the IRS wants to make sure that 401k plans benefit all employees and that we don't have too many of the benefits going towards the executives and business owners within a business. But what that can mean is that any highly compensated employee, which is defined as somebody who earned $125,000 in 2019 or $130,000 in 2020, that even if you're not in management ranks, you can still be hit by this rule and unable to maximize your 401k plan. Now, as you probably have guessed, this is a big problem for high income earners because high income earners actually need to save more money and a higher percentage of their income typically to enable their lifestyles to continue at a level that they want in retirement. And part of this is because Social Security is not designed to replace high incomes, and there's a lot that goes into it. But just here's what you need to know. High income earners need to save more money for retirement in order to continue living a lifestyle that they are accustomed to. And so if you're not able to maximize your 401k plan, that's a big problem because now you have to figure out where are you going to save that money in the most tax efficient way possible. So a couple of accounts that we would look at next for people who are affected by these rules would be to consider healthcare savings account. So if you have a qualifying high deductible healthcare plan, have you maxed out your HSA? Does a backdoor Roth IRA make sense for you? So a lot of times if you're getting caught up in this highly compensated testing, if you are married, it's possible that you are able to still contribute directly to a Roth IRA. But oftentimes what I'm seeing is that in these dual career households where both people have careers, that they are earning too much money to directly contribute to a Roth IRA, which is okay if you can do a backdoor Roth IRA. But there are some tax traps here that you need to be aware of before you dive into that pool. So talk to a financial planner or CPA and make sure that strategy makes sense for you before you execute it. And then, of course, we can always turn back to the often neglected just regular taxable investment account. And when we do use a taxable investment account, we want to make sure that we're maximizing the tax efficiency of our investments. And so that gets into what investments are we holding in which account, which I help my clients with because we don't want to pay a ton of money in taxes every year while we're trying to build wealth, because we can build wealth a lot faster if we're not constantly paying out a lot of money to the government in taxes each year. So if you are an individual who has received back money from your 401k plan, or you've been getting it every year and you just don't know what to do about it, I encourage you to reach out. My name is Lauren Zangardi-Haynes. I am a certified financial planner, and I'm the owner of a fiduciary fee-only financial planning firm called Spark Financial Advisors, where I am focused on helping high-earning business owners and dual career couples make the most of their money so they can focus on living lives that they love. Thanks so much for watching, and I'll talk to you soon.